Welcome back, guys. In today's video, we are going to learn about options trading. In the past lectures, we covered everything from stock investing to technical analysis to fundamental analysis. Now we covered the futures as well. And if you guys have been following from past 2 3 days, the trading session, the market is falling quite aggressively. So in the previous video, I was talking about what are the hedging strategies that you can use in order to safeguard your portfolio. But in today's class, we'll be learning about options. It's going to be, a big. There are like many series of this particular options trading because I won't be able to explain you options trading in like 1 2 videos. So let's get started. And in the meantime, tight your seatbelt and let's get together into this journey. Call options. So there are two people, okay, in this scenario, Ram and Sham. Let's say Ram is having 5 lakh rupees of capital and he wants to buy a shop which Sham owns, and that shop is worth of 50 lakh rupees. But how much money is having? 5 lakh rupees. But the catch is he don't want to buy it right now. He's anticipating that on this particular street, government is going to construct, let's say, some kind of park, or let's say there's a highway project which will be connecting, which is going to connect to this particular street, which will eventually make this street much more cr- crowded, and at the end of the day, his shop worth will be much more than this. So what Ram does is, Ram will pay token money of rupees 5 lakhs to Sham, and he will say that I'm going to buy this particular shop 6 months from today, because he's anticipating that the first, he want to confirm that if the project comes to this street, then only he'll buy that shop. Otherwise, if the project, don't come, there's no use of this shop because the price is not going to increase. Let's assume. है ना? So what he'll do, that he will tell Sham to take this 5 lakh rupees and get into a contract where Sham will be giving this shop after 6 months at 50 lakh rupees. I think now you're clear. Let's take now this contract. They signed the contract and now everything is done. Now let's take a scenario 6 months later. We have three scenarios now. First, that actually the highway got connected to this particular street and the price of this shop went up. So what will happen in this case? Ram will exercise his right because he has already given the token money of 5 lakh rupees to Sham, and with the contract that he's going to buy this shop at 50 lakh rupees, and the shop went, the price of the shop went to 1 crore rupees, but the Sham has to sell the shop to Ram at 50 lakh rupees only because he got into an agreement and he got that for 5 lakh rupees. Let's assume that the price, there's no such government contract that came into this particular street. There's no highway building and there's no park construction going on into this project, and this was just a fake rumor. So what will Ram do? He will just forgo, like he has to forgo this money, because at the end of the day, even if he try to exercise his right to buy 50 lakh rupees, at the end of the day, like it won't be profitable for him. So what he will just simply do, okay, you have taken my 5 lakh rupees, I'm not interested into this particular shop, because at the end of the day, even if he buys this, like there's no use of it, because at the end of the day, he's not getting it at an increased price. Let's take scenario three. Something worse happened into this shop. Something worse happened to this particular street, and the shop price actually went down. Again, what Ram will do? Ram won't exercise his right. The 50 lakhs ka shop became 30 lakh rupees. But obviously now Ram won't be buying the shop, because why will he buy something for 50 lakh rupees if he's going to get the same thing at a market price of 30 lakh rupees? So again, he will, let go his 5 lakh rupees of capital. If you understood this scenario, all the three scenarios, if the price of an asset remains the same, there's no use of Ram, making any kind of deal, because at the end he's not making profit. if the price of the shop went down, only if the price of the asset goes up, then it makes sense for him to exercise his right. In the other scenario, if the price of an asset goes less, still there's no use of exercising right, and you will just forego your, premium that you paid. So I think I'm very clear. This is exactly how options work. You are going to pay a premium for something, a premium, matlab a token money for something, for an asset, and predicting that the asset price will go up or down, according to your contract. And if your trade aligns with the intention of the market, the trend of the market, you will exercise your right and make money. I am talking only about the expiration. If you try to exercise your contract on the day of expiration. So what exactly it is, I'll tell you later. So for now, just understand this, that this is how exactly option works. An option is a financial contract that gives the buyer the right, but not the obligation. So I have the right to buy that land for 5 lakh rupees, oh, for 50 lakh rupees, just by giving 5 lakh rupees. So in a scenario, if the shop price went actually to, let's say, 1 CR, so how much profit do I make? I make a profit of 45 lakhs, because 5 lakh rupees token money I gave, 50 lakh rupees I agreed to pay after 6 months. So 55 lakhs is my cost. 1 crore is the shop current market price, and I gain 45 lakh rupees. In another scenario, I lose 5 lakh rupees, and in the next scenario as well, I lose just 5 lakh rupees. So, like in the two transactions, if the shop price went down or it remains the same, I just lose 5 lakh rupees of capital, because I don't have the obligation. It's not like I will do it. So obviously, I've written a contract that I can buy. I've stated in such a way that I can buy this thing after 6 months. But I will buy it at this price. But it's not my obligation to fulfill this contract, because I'm not telling I'll do it. Just understand this. So, options is exactly the same. You have an option. So actually, it's a literal English meaning. You have an option to exercise it or not. But you have all the rights to. That is the thing. Options are a significant part of the derivative market. In India, nearly 80% of the derivative traded are options. So it's a very huge market. India by far is the biggest derivative hub of the world. So in the 1920s, the custom options as OTC trades, and we are talking about the history of options market. In 1972, equities options came into existence, and in 2000 to 2001, they launched a couple of index futures, index options, index stock options, and single stock futures in India. So now you have like many securities to buy and sell into. And in 2006, real liquidity seen in India in index options, even though it was launched in 2000 and 2001 time. So now this liquidity became so huge that we are by far the biggest market in derivatives, Indian stock market, I'm telling. So let's talk about the European options and the American options. There are two type of options, like the theoretical things I'm talking about. So when you see CE by PE anywhere, that is called European. Put European. But there's another thing, that's American options. CA or PA. Exercise any you. So what is the difference between the two? In European options, in our market, we have European options, and you can exercise the right, whatever I was telling you, on the date of expiration. So after 6 months only, I'll be able to get into I'll be able to fulfill the contract for that particular shop. But in American options, let's say the shop price went from 50 lakh to 70 lakhs in 2 days. In the next 2 days, the government constructed something, and there's a buzz around, okay, this property price is going to increase. And what we did see is the price of shop went to 50 lakh to 70 lakhs. In American options, you can exercise your right at any time, but not in Indian markets, obviously. So that is the difference. So I can just go and tell the owner to sign, and I'll be making 20 lakh rupees in 2 days if the if we are following American options, but we are following European options in Indian market. I don't know the reason of that. Let's say take a scenario. Ajay pays 1 lakhs for the right to buy a land from Venu at 5 months or at 5 lakh rupees in 6 months. So that is the same, another scenario. There's Ajay and Venu, and Ajay pays 1 lakh rupees and he has the right to buy that land, that piece of land for rupees 5 lakhs in the next 6 months. If the what are the three scenarios? If the land price increase, Ajay makes profit. If the land price decrease, Ajay walks away. Just he will lose that 1 lakh rupees of fees. Land price stays the same. Again, Ajay walks away and losing the fee because why will he exercise any kind of right if he thinks that the asset price has not increased? Uh, I think I'm being too much theoretical. I'll just in a minute go to the liability terminal and show you how exactly. This is very easy to be honest. Like how exactly options works in market. It's very easy to say okay what your view is. If your view is that okay this asset is going to increase, you have two options. If this asset is going to decrease, you have two options. You can just type it out and in 1 minute you'll be able to buy options. So stock market context. So right to buy a stock at future date for a fixed price. So that in the previous example I was talking about the shop and the land. Let's stick to the stock markets. How exactly things works. So you buy stock at 75 rupees after paying 5 rupees premium. So some stock is at 75 rupees and you are buying that particular stock just by paying 5 rupees. But you have the rights to exercise. How much did you pay for that stock? 5 rupees into the lot prices. That's why people do it because it's much cheaper to actually trade into options. So if the stock prices increases, so your premium price increases. And let's say the 75 stock went to 80 rupees, you make 15 rupees minus the premium, you make 10 rupees. 10 rupees on a, let's say, a stock lot of 250, you make 2,500 rupees. Yeah, that is the calculation. So, at just by paying 5 rupees premium, you can anticipate if the stock price can go up or down. And on the basis of your calculations, you can just go ahead and predict. Same with the sell side as well. We'll talk about everything in detail. So stock price increases, you make money. Stock prices decreases, you will just let go the premium that you have paid. Here I'm talking not on any day you can just go ahead and do your trading, but on the expiration day I'm talking about. So if the stock prices actually went from 75 rupees to let's say 60 rupees or 55 rupees, obviously you won't exercise your right to buy a stock which is currently which you agreed to pay 75 rupees on the date of expiration, but you are going to pay but the market price of that stock is 55 rupees. Why will you buy this thing? So and if it remains the same, again you will not buy the same, and you will just let go your premium because you don't know if the stock is going to fall or it's going to rise. So what are the options jargons? So there is strike price. So, 50 lakh rupees, what I tried to decide. Okay, these are the things, I'll try to slowly digest you. So let's say in the next slide, we'll talk about the strike price. In the scenario of that our shop, we were taking the strike price to be 50 lakh rupees. Okay, that was the strike. So I am betting my money on that 50 lakh rupees. Okay, if that 50 lakh rupees goes up, I'll make money. If that 50 lakh rupees goes down, I don't make money. So in the case of stock markets, this is called strike price. You're betting at different amounts. So let's say stock is trading at 100 rupees, you have an option to take a trade at 100 rupees, 90 rupees, 110 rupees. So these are the different strike prices that you can see. Let's say in Nifty 50, I think it is the scenario of somewhere around 2017 or 18. No, actually it is around 2022, 2023 because the market in 2019 was around 7,000, 8,000. So the 15, 16,000 will be somewhere around 2021, 22. So these are the different strike prices of Nifty, and you can see something called written as call, put, bid, ask, LTP. These are the things. So bid ask is nothing but the what is the buying price that people are trying to take. What is the so you obviously sell at a higher price. So ask is selling. So for call also there's buy sell. There's put also there's buy sell. I'll get it into detail. So strike price, I think you understood. 50 lakh rupees. I'm betting my money on 50 lakh rupees. I'm betting my money on 60 lakh. So in the actual contract, I could just go ahead and tell that I'm going to make I'm making this 5 lakh rupees of payment in order to buy this asset for 60 lakh rupees, 70 lakh rupees, 30 lakh rupees. I can just go ahead and try to assume different figures. In the same way, you can go ahead and you know take a trade into different strike prices. So there are a lot of options available. So you'll get 10, 15 strike prices up and down from the from the at the money price. At the money is basically the current price at which the market is. So let's say Nifty is at 20,500. So you have options of 20,500, 20,550, 20,450, 20,400, 20,350. These are like at a 50-50, strike gaps. You can go ahead and there are a lot many asset prices. Let's see what is the underlying. From our case, the underlying was shop, like exactly the shop, with the land and the building itself. So the price at which the underlying asset is traded in the spot market, let's say Asian Paints is the asset, and the current price of Asian Paints is, let's say, 3,000 rupees. So in these scenarios, our asset will be so our underlying price will be the price at which the security is currently trading. So shop also that at that time at today's price, shop was at 50 lakh rupees. So underlying price is 50 lakh rupees. I'll try to exercise my right based on the underlying price. For a call option to be profitable, the underlying price must increase above the strike price. So you have paid some kind of premium, and with the additional premium, the price of the underlying should go above that, minus the premium, then you'll make the profits. The act of claiming your right to buy the underlying asset at strike price upon expiry. So options can only be exercised on the day of expiry. So what I would suggest you personally, not to exercise your rights, you should exit all your positions before the expiry date. Because even if it is options, even it is futures, because this whole scenario of exercising your rights itself is so much long. Because in order to, if you are even if you're let's say if you are into buying side of this particular options, uh, you have to forego your strike, you have to forego your premium, and the strike price at which you have told that you are going to buy that particular share. Let's say you have to have that much amount capital into your account. If you are selling, if you are into a sell side, you have to have those many number of shares into your demat account if you want to exercise your right. So let's take a scenario that you actually want to exercise your right. So what is the scenario in that? If you own an ITC call option with a strike price of 340, you can exercise your right to buy ITC share at 340 even if the current market price is, let's say, 360 or 280. You have all the rights if it is in the money option. So if it is in the money, that means the contract has some kind of intrinsic value. Because if it is out of the money contract, we will talk about in the later section, what exactly is out of the money. So you understand today's current market price of ITC is 300 rupees. Let's say, and you have bought an option for 340 rupees. So I told you there are different strike prices that you can buy the option at. So 340 is out of the money. 300 if is the current price. So if you have an option of 280 or let's say 260 rupees ka option, then you can exercise your right. If it is out of the money, you won't be able to exercise your right. Option expiry. So the date on which the option contract expires and the right to exercise the option ends, this is called option expiry. Equity options in India expires on the last Thursday of every month. So we have all the stocks together, which are in FNO segment, futures and option segment. They expire every month on Thursday, last Thursday of every month. So you have, I told you in the future series as well. Same in the option series. You have 3 months ka options available for stocks current month. So this is what is right now August. You have September, the mid month, and you have October. the far month. So you can trade into three of these instruments. So the current month ka expiry will be last Thursday of August. So on that day, the you just assume that the contract is going to die because you won't be seeing that contract into existence for the, let's say, coming year, because next again August will come and you will be able to see that particular option. What is the premium? So the token money, what I was talking about in the land example and the shop wall example. In the option premium that I paid at that time was 5 lakh rupees, and in the land example I paid 1 lakh rupees. If at all that price goes up and down, I will exercise. So that and the 5 lakh rupees token money. So that was the premium that I paid for that shop. So option premium is nothing but the premium that you have to pay for to trade in the underlying asset. So the prices that an option buyer pays, you know, to the seller for the right to buy or sell an underlying asset at a predetermined price with that specific period. So you pay some premium, and there's some kind of expiration date for that contract, and you can exercise your right on the day of expiry. And if you don't want to exercise your right on the day of expiry, if your option premium increases or if it decreases, you can buy or sell. You can sell the contract if that option price increases or decreases whenever you want before the expiry date. So I can buy today, Reliance ka futures, Reliance ka options. Sorry, we're talking about options, right? So we can, and the price of Reliance today, let's assume 3,000 rupees. I bought a call option of Reliance for this month, and let's say the price of the Reliance stock went 3,000, say 3,100 tomorrow. I have the contract. I have paid some kind of premium. Now the price of the underlying has been increased. So I will be getting more profits from the same trade because my premium will also increase as the price of the underlying increase. And as soon as I make some kind of decent profit, I can just go ahead and don't exercise, and I can I have an option that I don't have to exercise my right on the day of expiry. I can just go ahead and trade into the market, sell that option, and make money today itself. That is what option premium is all about. So 5 lakh. Just assume that 5 lakh rupees that you have paid to that shopkeeper. Imagine that 5 lakh rupees you are trading into market, and that 5 lakh rupees became 6 lakh rupees because there's some rumors around the city that the street is actually getting a contract from the government, and there's a highway connecting to it. So your 5 lakh rupees premium went to 10 lakh rupees. So you can just go ahead and give that contract to someone else. Okay, I don't want to exercise my right on the day of expiry after 6 months. I just want that 10 lakh rupees so that I've already paid that 10 lakh rupees to him. Now it is 10 lakh rupees. You just go ahead and you buy the option at that time. I want my 5 lakh rupees profit in 2 days. So that is about option premium. So option premiums moves very rapidly. You know, you can actually make 5x, 6x, 7x. I'm talking about the 700 percentage, 800 percentage ROI in a single day, 1,000. Like some actually go up to 100x in a day. So that I'm talking about a 10,000 percentage increase, 9,000 percentage increase. So on the day of expiry. So because there on the day of expiry, the momentum in the market will be super high. That's you have to understand. So the option premium will depend on the factors will be affecting to time to expiry, what is the current underlying price of that particular asset, what is the volatility of the underlying asset, so how much it is increasing and decreasing it in a day, what is the strike price, what is the market interest rate. So these are the things. I'll talk everything into detail. For now, just understand this part, okay, how exactly things works. So, what is option settlement? The process by which gains or losses from an option contract are realized. Options are typically cash settled in India, meaning the buyer receives the cash equivalent of the profit instead of the physical shares. So in case of futures, yeah, like they are settled shares wise, but in case of options, they are settled as a cash position. So whatever money that you are making, so you are making on the day of expiry, the cash will be settled into your account. You made profit of, let's say, in that scenario, we were making 2,500 rupees profit, right? So 2,500 rupees profit will be settled into your account instead of the physical shares traveling around. So I'm talking about only in our Indian market, because there are places where options are exercised even with the help of physical shares, not the cash settlement. So what will be a profit? The underlying price of an asset. So underlying price of an asset is like what we were thinking. The price of shop went to 1 CR, 1 crores, and the strike price 50 lakh rupees. So strike price is something that we bet our money on, 50 lakh rupees. Underlying price is something which is at the current market price of that share. Let's say the property. So 1 crore rupees minus the 5 lakh rupees, 1 crore rupees minus the 50 lakh rupees, 50 lakh rupees. So, and the premium that you paid, you deduct that. The 5 lakh was the premium that I paid. So 45 lakhs, as I was talking about the profits. So 45 lakhs is the amount of money that I made from that particular transaction. In the case of shares, in the case of index, underlying price. So the ITC stock went from 300 to 350. So 350 is the underlying price of that instrument. I betted my money on 300 rupees, so 350 minus 300. 50 rupees I gained. In the number of shares, 250. And the premium that I paid, let's say 17 rupees. 17 rupees into 250, that is what I say. So if you do all those calculations, that'll be a profit. Don't get into, think, okay, this is super tough. It's very, very easy. Just theoretically, it sounds very, very tough. I'll just go to the terminal and show you how exactly to exercise your rights. Building a case for a call option. So, it is trading at a 52-week low, the quality of a fundamental stock, the potential for price rebound. Let's say a stock which is at its 52 weeks low. We are talking about the breakouts thing when it is 52 week high. You should, make pump your money and buy that particular stock. But let's take a scenario of a stock which is trading at a 52-week low, good fundamental stock, the profits, the revenues, the debt, everything is super good, and there's a potential for price rebound. Let's say it's taking some support on 200 EMA, or 100 EMA or 50 EMA. So you can create a strategy out of it and avoid delivery and futures due to potential short-term losses. So, you have to exercise, you have to exit the positions before the day of expiry. You have made this strategy as soon as some good fundamental stock comes to a support of 100 EMA or 200 EMA or 50 days EMA. This is all I'm talking about, the daily time frame, DMA, DMA, DMA. And if a good stock is falling, you can just go ahead and buy options. And tomorrow there will be 2-3% up. Your options will be somewhere around 50% up, because that is the movement that you get in options. Make a ton of money out of it. Buy call options to benefit from a potential price increase. So you can buy a call option to benefit from a potential increase. Let's take no we'll take example from the internet. That'll be good. Let's take uh, ITC share. So ITC, let's see the current price of ITC. So ITC is trading at 486 rupees right now. And we are talking about the call options, okay? Just the price of property increases. So today we are going to only talk about the call options, buy, sell, both things. Let's take ITC at 480. Will be trading at 480. Yes. So I have the C option. I have options at different strike prices as well. That's what I was trying to show. So I can exercise my right at 500 also. I have a scenario. I'll take three scenarios. What exactly happened today? 460. Hmm. So let's say the price of it is 486. I can just go ahead and buy this. I want to buy at the money options. I'm thinking that the price of ITC will go up. Okay, so this is called at the money. What is the premium that is written here? 16 rupees. 16 rupees is the price that I have to pay, let's say in delivery. Delivery means, you are going to hold it for till the August last Thursday. You can exercise your right anytime, but you can go ahead and trade that instrument anytime. Exercise your right on Thursday, last Thursday. So this is the premium that I was talking about. So how many shares you're able to buy? 1600 shares you're able to buy at six, but just by giving 16 rupees premium. So let's calculate how much amount of money that you're paying right now. 1600 quantities into 16 rupees some paisa, 25,000, 26,000. Okay, so this is the amount of money that is required to uh, make a buy position in ITC. So let's take a scenario where the price of it, you can just see that today the ITC ka price is somewhere, so 0.06 percentage the stock price is up, just 30 paisa, and this actually option moved 2.5 percentage. So that is the just a 1 percentage move can make you super rich. I'll tell you about everything. So uh, let's take the ITC share. So how many, first we'll see how many shares I can buy for 60. What is the price of 1600 shares of ITC at 486? 1600 rupees into 486. So this is what I'm talking about, cash buying. So I require 7,77,000 rupees in order to buy 1600 shares of ITC. with the same with the same scenario, I want to buy 1600 shares, but I can just pay a premium price, and you're not actually buying this. You at the end of the day, you're not getting any kind of delivery for ITC. Matlab, you're not having shares of ITC into your account, but you are able to get 1600 shares for 16 rupees. If the price of ITC goes up to 500 rupees, let's see how much money we'll make. So 500 rupees minus 486. How much is it? It's 14 rupees. So 14 rupees into 1600. That is the amount of money that because I've already paid the 26,000. That's what I'm imagining, that you have an account of 26,000 rupees into your funds, and you bought at the money, that means 480 rupees ka strike price ka ITC at 16 rupees, and it went up to 500 rupees. Okay, the stock price went from, so our underlying price is 500. Now our underlying price is 500. So the price at which we were trying to exercise our right at was 486. So you make money around 14 into how many shares we bought? 1600. 1600. So on an investment of 26,000, you make 22, you have made 22,400 rupees, just because the stock went up. How much percentage up? If you calculate, you know 48 is 10 percentage, 4.8 is 1 percentage. The stock price went up five, like 3% up, I guess. Yes. So I'll just calculate 486 ka 3% up is 14 rupees. So 486 if I add it, yeah. So just by 3% up. So if you would have bought, 7,77,600 into, you calculate 3% up of this exact amount of money. But how much premium you paid into this? 26,000 rupees. How much it requires you to pay for all the delivery of shares? 7,77,000. So for the same number of shares, you paid how much less money? You paid actually very, very less money in order to make financial gain out of the scenario. So that is about options. It's a very good instrument to trade in. Like personally, I trade in stock options a lot, not in index options, because stocks, if you have analyzed this, you have analyzed the stock, and because stocks move into a very good scenario of support and resistance. They'll support your support, and they'll actually agree to the chart pattern, whatever things that we have learned till now. All this scenarios of the stock price coming to support, again going back, coming to resistance, falling. This is what stock follows. So you just I've, I've come to this 15 minutes time frame. Every time it moved to this price, it went down. Again it kind of went up, again moved down. Again, it tried to go up at 497. Again it went down. Again it went to 497. Again it went down. So you see how it is following the resistance. So every time this price comes, you can just go ahead and sell it. Every time, let's say this price comes 490, because it has taken support at 490 multiple times, right? 490, 490, 490, 490. So because it's very hard to predict an index, that how exactly things are going to happen, but in stocks, the levels, particular support resistance levels, they work very good. Every time the stock would have went to 490 rupees, now actually it went lower. So like, as soon as it crosses this 487, crosses the 490 level, comes into this channel. If let's assume we bought this particular ITC for 16 by paying just 16 rupees premium, 26,000 rupees. It comes into this channel, you sell it. It comes into this channel, it comes 497. It comes into this channel, you hold it, wait for it to go at 497, you sell it. So you make a very decent profit just by analyzing stock options. Let's take a so you will think that for 500C, if I do the same thing, and actually this 500C went down 4% today. How come? Uh, Very good question. This is out of the money contract. So 486 is the current price that you see. 500 is the price. 500 is the price that the stock, we are thinking that the stock will go up to a certain percentage. But because there are a lot many factors, theta, vega, rho, gamma. I'll be talking about all of these things in detail. How exactly the price of premium is determined. So you'll think that how exactly the 16 rupees. Why am I paying 16 rupees? All the things we'll question, and we'll answer it into the later section. But now you understood, I think, how exactly to buy options. So you don't have to go ahead and buy options. First, understand the full theory and pay a premium, buy a particular asset, make money out of options. So it's very easy to buy and sell options. And that because today the market actually closed. Tomorrow, I'll show you how exactly we exercise the rights to, buy and sell options. It's very easy. So you just go ahead and buy, and it'll be into your positions, and you can just go ahead and sell. So that is about options. Let's continue. So now I think this is much more practical. You can just go ahead and see the stocks of any stock you see. Any big stock you see, it will be options. 2,900 is the price. Lines 2,900. See, for the month of August. So you have for the month of September and you have options for the month of October as well, 10th October. So this is actually, yeah, this is actually the monthly expiry of the options. So you can just go ahead and buy August, September, and October as well. So the further the date of the expiration, the costlier it will be, obviously. So I have taken CEP both the scenarios. Let's take. No, I'll just talk about CE for now because I think you'll get mad at PE. So you have two options: buy, sell. So if you think the markets, I'll just talk about the buy thing. So if the price of this Reliance goes up, you make money in C. If you sell a C, if the price of the Reliance goes down, you make money. But see the difference of the amount of margin that is required. So 18,000 rupees is required from you to bet on the upside at the money price. 1,40,000 is the amount that you require in order to make a prediction, okay, that this stock is going to go down. So I'm talking about only the call scenario. I'll show you the put scenario, and you'll understand what exactly I'm talking about. So just understand this, that you need a very high margin in order to sell a security, but in order to buy a security, you need a very less margin. So if you want to, let's say, sell this for 80 rupees of ITC, where you'll make money when the ITC ka stock will fall, you require a margin of 1 lakh. So 1,58,000 is the amount of money that you require in order to make that trade. But in case of buy side, how much it is required? It is required only 26,000 rupees. And I'll, wait for some time. I'll actually tell you how exactly things works. Why the premium is different in the case of call ka C, buy ka option buying and option selling in C. Why the option premium? Why there is a difference between uh, premium of put ka buying and selling. So this is because the one is having the rights but not the obligation, but the other one is having the obligation, not the rights. Well, they are having the rights and the obligation as well. One gives the premium, one takes the premium. So, imagine a scenario where this Ram Sham scenario where he's the buyer, he's the seller. So he pays the premium, he takes the premium. How much is the upside for him? The upside is actually just the 5 lakh rupees. He's just hoping that the price of that particular shop doesn't go up. And that's why he's taking that 5 lakh rupees in order to, gain from that scenario, because now he will have the shop as well as the 5 lakh rupees. But in case of the buyer, he's hoping that the price of shop actually goes up, because he only makes money if the price goes into his direction. But the seller, in both the case, if you think about it properly, even if the shop price remains the same, he gets that 5 lakh. Even if the price of the shop falls, he makes that 5 lakhs. So, which is better in both the scenarios? I think the one who's selling option is better, right? Because he's gaining from two possibilities, and this buyer is only gaining from just a single possibility. So there's huge risk for option buyer, but there's not that much risk for option seller. But you imagine that price of shop goes to 1.5 cr. What is the upside for option buyer? The upside for option buyer is unlimited. So if that price of that shop went 2 cr, just by paying 50 lakh rupees, he's able to make 1.5 cr without even actually owning that shop. What is the downside for him? He only pays 5 lakh rupees. Even if the shop price goes up, down, doesn't go up, doesn't go down, he should not care about this. The worst scenario is he lose 5 lakh. The best scenario is he makes unlimited money. What is the upside and downside for option seller? The downside for option seller is, he can actually have unlimited losses, because the amount of money that option buyer is able to make with the the price of shop went 1.5 cr, 2 cr, and because he agreed to sell this particular shop for 50 lakh rupees, now he incurs a loss of 1.5 crores. But you will tell that okay, he would never know that the price of that shop would go up. He just did it because he was thinking that the price of that shop will remain the same, or actually it'll go down. But that is the markets are all about. The one whose expectations wins, whatever his intention is, and the market gives you the same kind of direction, you win. If the direction goes into opposite direct the opposite way, you lose. That is about. So this is a zero sum game. So if someone is making money, maybe you are losing money, and if you are able to make money, someone is losing money. So there's other side, of the screen where someone is totally trading opposite of us, and if we are making profits, he's making loss, and if he's making profit, I'm making loss. So this is the game all about. So we talk about the option expiry, option premium. So now you know how easy it is to go and buy options. Just go on it, select the strike price, click on and select C, click on buy, go ahead with the transaction. What about selling also? Selling also, I'll teach you how exactly things works. So in the scenario first, 486 was the current price of the ITC. We selected the strike price 480 rupees. The premium that we were paying was 16 rupees. So, we have a belief that ITC is going to go up because the whole market was falling down faltu mein, and at the end of the day, the price, because the ITC is going to demerge, and one of the segment is going to make a lot of money. Uh, you are just bullish about the scenario that ITC share price will go up. So that was your belief. And why did you exercise the call option? Because if you would have invested that 1600 shares, 7,77,000 into the transaction, let's say the market crashes 10 percentage, your stock will also go 10 percentage down. So you actually incur a lot of loss. Instead, you just 10 percentage, so 7,77,000 cuts 10 percentage will be 77,000 rupees. Okay, so 77,000 is what you're going to lose. But in options, only you paid a premium of 16 rupees. That is 26,000 rupees. You're going to lose that 26,000 rupees. You're not going to lose any penny more than that. So, in order to minimize the short-term risk, there should be a belief you exercise option, and option is the way forward. So let's talk about the intrinsic value. Intrinsic value is a non-negative value if the option is exercised profitably. So how an option will be exercised profitably if that particular option ka the price of that option is in the money. In the scenario of 486 rupees stock price, our price was 480 rupees. Strike price was 480 rupees. So there will be some kind of premium if you will be out of the money. I was showing you that 500 rupees ka ITC is costing around 6 rupees, right? 6 rupees, you can just go ahead and buy 1600 shares of ITC. You'll be thinking that, damn, that's too cheap, right? 6 rupees into 1600, that'll just go around like 36, and 9600. So, for 9600, you are able to purchase 1600 shares of 90C. But man, that 9600 can go down as well. So if that stock price never went up, let's say from 486, it kept on falling, falling, falling. You just lost your 9600 rupees. But if the price of that stock went up and up and up, you make all that profits. So the spot price minus the strike price, and in the previous example, we were thinking how exactly you figure out how much money you make. Whatever is the price of that underlying right now, minus the spot price that purchase that particular share into the quantity minus the premium. That is the profit that you make. Because you have to calculate that you did pay 26,000 rupees. So you have to deduct in order to arrive at a profitable figure, how much money you made, you have to deduct the premium as well. You can just calculate, okay, from 16 to 19, the premium went, I made 3 rupees. That's how we do it. Okay, the 16 ka premium went to 20 or 25. So 25 minus the 16 into 1600. That is what your positions will tell you, that this is the amount of profit that it's currently trading at, and you can just go ahead and sell that particular asset, and you'll make profits. Generalizing the PNL. So we'll take different scenarios. So in the case of this, I think we didn't pay attention to this. 2026 was the current price. We selected a price of 2050 at a premium paid of 6 rupees, 35 paisa. So, you know, 2050 is the strike price that we selected. So what I'm losing right now, if the price of stock remains 486, and the August month ended, and we were exercising that 480 rupees ka strike price, see, and even if that 486 ka went to kept at the same price after a month, so you'll lose 16 rupees premium if you are holding it till the end of expiry. If it goes other way, so 2026, I think we bought the stock at, let's say, the stock went down 2040, 2030, 2020, you're going to lose that 6 rupees. So you'll just let go your premium because you don't want to exercise your rights. Why will you exercise your rights? Because there's no use of holding that particular thing. Because the stock price at market is much more lower than the current price, the price that you bought the security at. Let's take a scenario where the stock price actually went up. So, you know, 26, let's imagine that stock at a 2050 strike price, it went to 2060. So this is 10 rupees move. So 10 rupees minus the 6.35. So 3 rupees is the amount of money that you make. At 486 went to 500. How much money you make? 14 rupees. 14 rupees into, you'll just calculate. Okay, 500 minus 486, that is 16 rupees, and 14 rupees, and 14 into 1600, so 14 rupees is what you earn. So 2050, so that he's calculating 2060 minus 2050, that is 10 rupees, and the premium paid was 6 rupees. You made 3.65. So now I'm not taking consideration into the 26,000 rupees. So if I take that consideration, what will be the formula of my, I'll tell you how exactly things. So 1600 shares. Okay. So 500 is the current price of ITC minus 486 rupees. We bought the ITC 1600 shares. Now, how much money we made? Of 20,000 rupees. But if you take into consideration the premium paid as well, so you have to add things. What exactly I have to have? I have to multiply with the quantity. No, well, 22,400 is the amount of money that I make. The stock, because the 480, sorry, 480 was the scenario. I'm so sorry. 480 was this spot price. So in this scenario, I'm deducting the 480 rupees, right? 500 minus 480. Sorry. Yeah. 500 minus the 480 gives you how much money? 20. And you paid premium of how much? You paid a premium of 16 rupees. 16.5 actually. So the spot price, so the current price minus the contract value multiplied by 60. So you just multiply both these amounts by 1600, and this is the amount of money that you make on the day of expiry. 5,600 rupees. So you'll be telling that how exactly I was making 22,000 rupees at that time and now I'm making 5,600. With that time we were calculating the cost of that time we were calculating that if the price of that security moves one rupees up, you are going to make 14 rupees. But in options, I told you, there are five things, five different variables that calculates the premium amount. And actually, it moves into such a direction that even if the stock price went up from like 486 to you know that 500 rupees, you won't be gaining 14 rupees on a premium of 16 rupees. You'll be gaining 3.5 rupees because 16 is the amount of that you have paid. But I'm talking about the day of expiration. you know Even if you hold the ITC for this full month, this is the amount you're going to make if that stock went up to 500. So how does the payoff look like? And even if that goes, further, I think you won't be you will be able to understand it now. So 6 rupees is the premium that I paid in this scenario, and 2060, 2070, 2080. So you just have to deduct the strike price of it, and then you'll deduct the premium that you have paid. So 23 into the number of lot size, that'll be your profit. So all these scenarios, different scenarios, just understand this. If it doesn't go into your direction, till if you hold it till the expiry, you're going to lose the premium. If it goes into your direction, even if the stock is moving up and up and up, there's the amount of there is unlimited upside. So you understand from this chart, the loss is consistent. How much amount of loss you're going to make? You're losing that. You can see that line, right? You're going to lose just 6 rupees. How much is the upside? The upside is unlimited. The stock went from 2056, 2063, 69, 2075, 282, 288, 294. So there's unlimited potential profits. There's limited, premium to be paid. There's limited losses. That's why people prefer options, because at the end of the day, what you're going to lose is just the premium. And if you did instead, if you just would have bought 1600 shares of, let's say, took it in delivery or did intraday some kind of thing, you will be in heavy losses if the security moves into the opposite direction, because there's unlimited loss on your full capital. You're just losing the premium. There, even if the stock went up 10 percentage, you are going to make 10 percentage on the amount of capital that you have invested in. Here, if it moves 10%, believe me, if a stock moves 10 percentage and you bought an option for that stock the day before, you are going to actually make, I think, with the leverage, you're going to make like a 200 percentage return, or 300 percentage return, or 400 percentage return. Because if we calculate the leverage, what amount of leverage we are getting into the transaction, just remove everything, 7,77,600 divide by 26,000, because I was able to get, so I was getting 29x leverage, 29x leverage. So if that's, if this moves 10 percentage up, my return will be how much? Multiplied by 10. Yes, 300 percentage. So your capital will be 3x if that stock moves, let's say, because you are getting 29x leverage, 30x leverage. That is the leverage that you get in options. That's why people tend to make a lot of money with the help of options, and they lose the same amount of money as well, because the premiums are so much volatile, and if you don't have the right kind of mindset, you will not be able to vary. So that was all about call buying. So what C ka buying I was touching, right? Now here comes C selling. So in this transaction, the same kind of transaction you were talking about, we were thinking about from the perspective of buyer who is going to buy that land just by paying a token money of 5 lakh rupees. So seller in this same transaction is taking that premium. So this is the job of call seller. So C buy, C sell. How he makes money? If that price of property goes down or it remains the same. That is what about seller. How option buyer makes money? If the price of the property only goes up. I think you understood by this example. I think you wouldn't have watched this film, but this film is Diwar. So there's a popular dialogue of this diva. One of the guys says that I have all the richness in this world. I have bank balance property. क्या बोलते मेरे पास गाड़ी है बंगला है तेरे पास क्या है so the other guy says like मेरे पास माँ है so this is the guy who's saying बस मेरे पास माँ है and he's telling that the seller is the one who's telling that मेरे पास पैसा है बंगला है गाड़ी है so that is about this you can take the scenario there are two sides of the same coin one is making money one is losing money so the fight will be consistent and it has been consistent from 2000 2001 in India and it's still running a lot of FIIs DIIs are and the retailers all together makes this market super super interesting and huge because I think there was a report recently and that says that like people are losing 10 percentage of the people are making money in this full options market and the market is that like they're expecting the growth to be 20 percentage so this market is going so up so you can just imagine there'll be a lot of liquidity you get into this particular field and you have some kind of strategy and with the help of that strategy you can make money in options and the options money will be much more higher than the amount of money that you are going to make in investments. So a lot of money that Rakesh Jhunjhunwala also has made with the help of trading in options. So trading actually just imagine a scenario where trading is called that they're just basically talking about the options and futures because most of the market is involved into futures and options. Similarly, in options trading, the option writer and the option buyer represents the two sides of the same coin. So the one who's selling is the one who's selling the option. In the case of the shop seller, right? That's called option writer in market in terms of stock markets. And the one who is buying, in the case of that guy Ram, he's the option buyer. So what I was showing you was the option buying thing and there's the other thing called the option selling thing. So there's no morality involved. It's just different market views. There's no something this is better, this is better. It's just two sides, and you can just pick your side and go into and trade into market. That's not it. There is put as well. So what we were talking about just the call. So this is called call European CALL is the spelling है ना if you don't know till now CALL call European so there's call buying there's call selling call buying if the price of if the price of the asset goes up call buyer will make money if the price of an asset remains the same or it goes down instead call seller makes money. I think you'll be very much through with this idea. So what are the key generalizations? So option buyer is having very limited risk. This is the premium that he is going to pay. You know, 26,000 is the only amount of money that I'm going to lose when I'm talking about the ITC thing. But what will happen to option writer? There's limited profit and there's unlimited risk. So unlimited profit matlab कि the price of ITC is 486. What's the worst case scenario? When I told you option writer is only going to make money if the price of asset goes down. So 486, if the 486 itself goes to zero, 486, 485, 484, like that it goes to zero, there's limited profit if you're trying to understand. But that 480 can go up to 1000, 2000, 5000, 10,000 lakh but 486 can go down to till zero. So there's limited profit for seller, but there's unlimited profit for buyer. One thing I think you're clear of that. So unlimited profit potential for option buyer, unlimited risk potential for option seller. So why is there is unlimited risk for option seller? 1 lakh something was required in order to sell that particular thing, because he will only make money if that price of the asset remains the same or goes down. What if I have sold a call option and the price of ITC is going consistently up? I'm going to, the broker is going to call me and will be telling that, okay, sir, your margin is short, and like, you have to put more amount in order to continue the same position. So if the price of the ITC goes, unlimited, that option seller is going to make unlimited losses, because there's no particular upside to a share, right? There's downside is limited. 486 is what the price. If zero is the price that it can go, but unlimited is the price that it can achieve. So the option seller is having unlimited risk potential, but option buyer on the other hand is having unlimited profit potential, even if the risk is very minimum to the premium that he paid. You know, because in option selling, the price of that thing goes up. You'll be seeing all the negative figures every day. You'll be seeing the negative figures into your account, and you let's take 486, right? 500 it become 14 rupees you're losing right now. You did an option writing on 486. Okay, so 500, so 14 rupees is the amount that you're losing. It went to 550. Now calculate. 54 is the amount that I'm losing. Went to 700, 800, 900. So the profit the losses will be every day, and it is an M2M. I think it's an M2M settlement. I'll just see to it and tell you in the next class if it is an M2M. No, there's no M2M settlement for this. No, no, no. And options, then only futures has M2M settlement. What does means by mark to market? So I'm not going to incur losses every day. All the losses I'm going to incur on a full position basis. So there's huge risk for option seller. That's what I'm trying to justify. If you're paying less money, you're going to lose less money. If you're paying a lot of money, you're going to lose a lot of money. So break even points, where when I'm going to achieve the zero profit scenario, zero profit, zero loss scenario. If that option buyers break even will be the strike price plus the premium paid. So strike price is like 480 rupees was the strike price, right? And premium paid was 16 rupees. So if that price went up to 496, there is the scenario where I make zero profits if I exercise my rights on the day of expiration. That is the thing. And what is the break even for? So 496, if the stock goes to 496, that is the time where I'll make zero loss uh, on the day of expiry. What will be scenario for option writers breakdown? So strike price plus the premium received. So the premium received in this case is again 16, and the strike price again I selected at 480. So strike price plus the premium no, premium received will be the opposite of it, right? How much premium is he receiving? I'll just change the tab and let you know. Yeah, here. Yeah, I'm receiving 16 rupees as a premium. So 16 rupees premium plus the strike price 480. 480 plus 16, 496 is the time when I am going to make a zero loss in this scenario. No, that'll be 480 minus. I think there's some mistake. Yeah, how could so 480 minus the 16, the premium that I'm going to receive. That'll because I only make money when the price of the security goes down. So 486 is the strike 480 is the strike price, and 60 rupees is the premium that I've received. So that'll be 400 70 464. So if the stock if the price of that stock goes to 464, then only I'll be making a break even profits. So I think there's some kind of glitch in that PPT. Uh, some yeah. So That is the amount. 464 is the amount. Then where I'll be making zero, yeah, where I'll be making zero profits. So this is a scenario of option writer seller. If that 250 rupees, I think you remember that example that we gave. If it goes to 2056, so 2056 minus 250 is the 6 rupees, and 6 rupees 35 is the premium that I actually got. So 6 rupees 35 paisa minus 6 is the 0.35 is the money if the price of that security falls. So 20 from 20, if the price moves from 2050 2056 to 2050 2056 because strike price was 2050, and 2056 is when I decided to do option writing. So this is the amount of money that I make. If it went further down, so let's say 2055. So you can see, right, the amount of money goes to, go like that goes into my pocket will be limited. If this goes to till zero, then only till that time I'll be able to make profits. If this goes to the opposite side, 2057. So 2050 is the price that I did option writing. 2057 minus 2050 is 7 rupees. And I received 6 rupees 35 paisa as a premium, and I have to pay 7 rupees. So 0.65 is the loss that I'm incurring. Tomorrow, I think tomorrow I'll be able to do it. Tomorrow I'll show you the live scenarios where how exactly the premiums work. We do a lot of options, so yeah. 2058, if it again goes up, you make loss. Again, it further goes up, you make loss. If it goes down, you make profit. Simple. So the chart, the payoff chart for option writer is opposite of the option buyer. So there he was making a limited loss. If you remember till now, this is the premium that he is going to lose. And if the price of property goes up, 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 that is the amount of money that, I mean, unlimited is the amount of money that he's going to make. Reverse. How much money I can make is limited because, if the price of that particular thing, let's take in the property scenario only. How much amount of the money that option seller was able to make? Just 5 lakh rupees, just the premium itself, because he is not paying any penny more than that 5 lakh rupees. So if that your scenario remains the same, the price of property does not increase. He makes 5 lakh rupees. If the price of property goes down, if it goes up, he loses all that money he would have made just holding that property and not getting into that contract. So 1.5 CR, 2 CR, 3 CR, 4 CR, how much ever the property went, he has to give this property to that person only for 50 lakh rupees. So there's unlimited downside. So if the price of asset goes up, ITC moves 500, 600, 700, 800, 900, how much money you are going to lose? You are going to lose unlimited money when you are doing option writing. So the margin requirement, option selling margins are generally comparable to future contracts. So the option selling margins are the same as what you require for option futures, doing futures as well. Yeah, I think you remember now the futures classes that you require a lot of money in order to do futures trading. Option writing, the selling part requires the same amount of margin, 1,60,000 that it was showing. Even if you do any kind of stock or the index as well, selling requires a much more high margin because at the end of the day, you are looking for the premium, that 5 lakh rupees. Because there's more probability of you making money as an option seller than an option buyer. So if you put more money, you will actually make more money. If and most of the times when the markets are kind of consolidating, let's take in the scenario of expiry, the markets will be consolidating, and you'll be getting all that premium out of the option buyer's pocket. And if the market moves into, let's say, your direction, you'll make money. But and there is more probability of you winning when you're doing option selling. So we'll show you how exactly to do option selling as well. You'll require a very less margin when you're doing it together with the buying and selling together. You have to pay a very less premium. We do a lot of option selling. That because when we are doing some kind of bull call spread, bear call spread, we're making we're making positions, we're making a strategy where we need to require buying and selling both the positions, which gives limited profits, limited losses. That's what you should aim for. I will teach you the strategies as well, how exactly to go for different strategies. The purpose is manage the risk exposure of option seller due to potential for unlimited loss. So you need to have a lot more margin when you're doing option writing because you are getting exposed to the humongous risk of trading because there's unlimited losses that you're going to incur. I told you the scenario if the price of the stock goes up and up and up, you have to pay a lot more money from your pocket. Otherwise, the broker is going to square off your position. So I think enough for this call options thing. I hope you understood some part of it, not full part of it. I expect you not to, understanding full part of it because for first time it is kind of complicated thing as well. But as we will walk through this full sessions, I hope that I will be able to convey my message how exactly options works. So now today we learned about the underlying price, the underlying price is nothing but the current price, the spot price, the price at which we are telling to exercise our right. So in that case was 50 lakh rupees. There are different strike prices. So strike prices is what you are thinking that the price of that particular thing, you want to exercise your right at a particular price. We learned about premium, that the buyer of the option pays a premium. The option seller instead receives the premium from the option buyer. Option buyer makes unlimited profit with limited downside. So what he's going to lose is just the premium. What this buyer of Ram was going to lose in the scenario was just the premium, right? 5 lakh rupees. In the scenario first, 3,000 rupees. In the case of ITC, you were losing 26,000 rupees if you hold it till the date of expiry. On the other side, how much money you can make? Unlimited. That if that goes into your direction, believe me, that's the best day in your life when you can make 10x, 100x amount, 100x your capital into a single day. I've seen it, people doing it. I've never done it by myself, but yes, they'll do index trading and they'll buy a option for 2 3 rupees, 5 7 rupees, and that goes to thousand, 2 3 rupees to thousand, and there's some 50 quantities, 100 quantities, 200, 500 quantities. Man, your life is settled if you capture that moment. So you can actually capture that moment. It's not that great. Uh, you can get all these moves on the day of expiry. So in the case of option seller, he's going to take that premium. So 5 lakh rupees is the amount of money that he's going to make. So 16 was the premium, right? So 26,000 is the only amount I'll be able to make when I'm doing option writing for 1,66,000 rupees. But there's more probability that I'll be able to get that premium. That's why people do option writing a lot. Most of the big players in the market do option writing. Don't get me wrong. Option buyer is just for the ones who are having less capital, the ones who are having more capital. Because at the end of the day, there are a lot of jargons that are involved in this. How exactly the price of options is determined. One of them is theta. As the time passes, your premium will decay. One of the variable. If I want to explain you. So, but as the time passes, you're going to lose your premium as an option buyer. As a call buyer, you are going to lose premium. If the contract is going to expire, that if the contract is going to expire in, let's say, next week, in 2 days, in one day, so you are going to lose a lot of options just because this theta. Option seller, on the other hand, will take all that premium because every day passes, he's able to make money. Every day passes, he's able to make money because there's theta involved in the full game. He's giving more money, so he will have that option of capturing all that premium from the pockets of buyers. So, but there's unlimited risk potential as I was talking about for the option seller, because if the price of a particular asset goes into the opposite direction, he incurs a lot of loss. And and the amount of capital also requires the amount of capital requires is also huge. There's unlimited losses, but there's only limited profit. So 16 is the only profit that he's going, because if the price of that goes down to 16 becomes zero. 16 is the only premium that he gets. So that is it for call options. I think I summarized it pretty well. Thank you so much for listening. And in the next class, we will discuss about put options, where what exactly P stands for, how you make money out of P, call selling P, buying P. Thank you so much, and I'll see you in the next class.